Debt and issuance, a huge story in 2018. Just over the last 12 months, federal debt has reached $1.27 trillion with a T. But here's an interesting fact. While that occurred, the actual deficit is only up $804 billion. Why don't you explain to viewers that discrepancy?
Well, there's a deficit in off-budget items of more than $500 billion. The actual deficit's 780, and then there's 500 billion or more on off the budget. Total increase of $1.25 trillion. That's the answer, pure and simple.
Now, that is something that's gone on a while in government. My question to you is, should we, or how nervous should we be regarding the size of issuance over the last handful of years? Is it something, it doesn't seem to be showing up. Interest rates actually seem rather well behaved, though at loftier levels.
The main determinant of the risk-free long rates, the long Treasury rates, is inflationary expectation, defined by the Fisher equation. And the inflation rate, in our view, has peaked for the year. It's turning down. There's been a major deceleration in bank credit, money supply growth. The Fed's draining liquidity from the rest of the world. The dollar is basically at all-time highs, except for a brief episode in the early 2000s. This serves as a deflationary pump. We have a synchronized monetary deceleration going on around the world. The inflation rate is heading lower, and ultimately that means that the bond yields will be heading lower, not higher. Supply is not a major issue other than for very short-term periods, because the increase in federal debt works with a negative multiplier, not a positive multiplier. It's debilitating to economic activity, and this will actually reinforce the restrictive monetary policy that's underway.
Very interesting take, of course, Lacy. Now, let's run with that. We have about a half a minute left. There is a dollar liquidity issue around the globe, and it may end all the divergence that we've seen with the U.S. economy, meaning it could pull us a little lower. Your final thoughts?
Well, I believe that what we're seeing is a synchronized downturn globally. Europe, Japan, China, the emerging markets, their economies are deteriorating. And the U.S. economic growth rate has been strong up until now, but I believe there are clear signs with downturns in automotive, housing sector, and capital equipment expenditures that the economic outlook will be considerably weaker going forward.